Hi, welcome to Third Umpire. In this episode, we review all the significant economic developments from the previous week and examine in detail how and why they occurred. Now, the Indian Rupee has been making headlines every day in recent weeks as it reaches new lows. Now, this is on the back of a strong US dollar, which is on a roll. Now, even as the American economy shows signs of cooling, the dollar index has soared against major currencies to a two-decade high. On Friday, RBI raised interest rates and also cut GDP growth forecast. Now, despite rising interest rates, credit growth in the country hit a 9-year high. In this Third Umpire, we will try to decode these news for you. Now, if you want to understand why the rupee is hitting new lows every day and why the RBI raised interest rates and cut GDP forecasts, do continue watching. You're watching Informed Investor, the Third Umpire, and initiated by Research and Ranking. As we are all aware, the rupee has been hitting record lows. Now, this is happening mostly on the back of a very strong dollar. The rupee was hovering around 80 for quite some time now. After the hawkish US Fed, in its attempt to fight inflation, hiked its policy rate by another 75 basis points, the currency slipped further and hit an all-time low of over rupees 81 per dollar. Now, it further declined to about 81.6 per dollar. While the Indian rupee has depreciated against the US dollar, do know that most advanced and emerging market currencies have also faced the brunt of a strong dollar. Now, if you see the chart on your screen, the rupee's depreciation sits somewhere in the middle of the Asian currencies pack. Among India's Asian peers, Vietnamese dong, Saudi rial, Hong Kong dollar and Singapore dollar have dropped relatively less, while the Chinese currency, Japanese yen, South Korean won, Thai baht, Philippines peso and Taiwan dollar have depreciated much more than 10%. Now, compared to advanced economies such as Euro and the British pound, they have also depreciated by about 13.7% and 17.8% against the US dollar respectively. Now, this shows that India isn't the only country really under the pressure, but most emerging and developed economies are too. Now, let's understand what's causing the rupee to depreciate. The rupee's fall is mainly due to high crude oil prices, a strong dollar and foreign capital outflows. Now, the strengthening of the dollar is the root cause of the problem. Now, what we mean when we say that the dollar has become stronger is that $1 can buy more of another currency than it could before. Now, the dollar index, which compares the currencies to all other significant ones, is at its highest point, rising and breaking through 114. Now, a high reading above 100 indicates relative dollar strength against other currencies. Now, let's understand why the dollar has strengthened. Now, before we explain, do remember that dollar is king and the dollar's rise affects nearly everyone. Take a look at this chart to understand why. The US dollar retains its dominance as the world's most widely held reserve currency, and it accounts for about 90% of all foreign exchange transactions. Now, it is given that the strength in the dollar will wreak havoc not just on India but the entire world. When US bonds used to pay close to 0% interest, foreign investors looked for better investments all around the world. Foreign investors chose to invest in Indian stocks or other emerging markets. Now, remember, the rupee value against US dollars changes from either inflow or outflow of dollars. When foreign investors were making investments in India, there was an inflow of US dollars that further strengthened the Indian rupee. Now, we all know rising and persistent inflation has become a global problem. Now, when inflation rises, interest rates in an economy generally catch up. Now, the US Federal Reserve increased the federal fund rate by 75 basis points to the range of 3 to 3.25% in its fight to curb inflation, which is at multi-year highs. While this was expected, the tone of the Fed chair made it clear that it will continue to raise rates through this year and has promised to bring back inflation to 2% levels. Now, with interest rates rising in the US, this makes bond investments in the country more attractive. Now, this makes it more lucrative for investors to keep their money in US markets than in emerging markets. Now, with interest rates rising in the US, A lot of money from all across the world, including India, are going back to the US, making the dollar stronger and other currencies weaker. Now, do know that we are also an import-dependent economy, that is, we import more than we export, and our trade transactions mostly happens in dollars. In this case, we are always in need of dollars. Global crude oil and commodity prices have risen since the start of the Russia-Ukraine war. On the back of this, our import bills rose. India's trade deficit in August widened to $27.98 billion from $11.71 billion in the same month of last year. Now, sequentially, it has moderated from a record high of $30 billion in July. Now, not long ago, we used to see trade deficit of about $10 billion to $15 billion. Now, our trade deficit has crossed $30 billion. Now, biggest trade deficit has been expanding month after month on the back of macroeconomic headwinds. Pressure is put on the rupee since many dollars are going out than coming in. This causes the rupee to weaken while further strengthening the dollar. Back home, the RBI is taking every possible step to defend the rupee, and as a result, India's foreign exchange reserves are depleting faster. Now, how is this possible? Do know that the rupee's exchange rate depends on demand and supply. In order to control excessive volatility, the RBI intervenes in the foreign exchange market by buying or selling foreign currencies, dipping into the forex reserves of the country. Now, this particular action has led to a decrease in our import cover and a depletion of foreign exchange reserves. The country's foreign exchange reserves decreased from $640 billion on September 16, 2021 to about $546 billion on September 16, 2022 as a result of the RBI's inclination to curb currency depreciation. Now, in just 1 year, we've lost about $100 billion of forex reserves. How does a depreciating currency impact the Indian economy? The primary and immediate impact of depreciating rupee is on the importers, who are hit hard when the rupee cost per dollar goes up. Now, since India mostly depends on imports and we make payments in US dollars, now if the rupee is weak, it has to pay more for the same quantity of items. On the other hand, a weakening domestic currency boosts exports. However, in the current scenario of weak global demand and persistent volatility, the cons of weakening currency outweighs the pros. Now, a falling rupee also hurts those looking for overseas education as their costs swell accordingly. Similarly, it is negative for those who have plans to travel abroad. Travel is another sector that will be impacted, especially since it has just begun picking up after the pandemic. Travelers from India will now have to spend more for their holidays. Now, there is a silver lining for non-resident Indians sending money back home from the US, as they will end up sending more in rupee value. Now, what are the key takeaways on rupee depreciation? While a falling rupee does have its benefits, the current situation will hurt India more. The weakening of the rupee is on the back of a strong dollar, not on account of India's domestic fundamentals. Now, considering the extent of tightening the Fed envisages over the coming months, the pressure on the rupee is unlikely to subside because of a very strong dollar. It goes without saying that credit growth is integral in supporting an economy of a country. Now, credit growth is the rise in loans given to individuals, businesses, and government entities. When credit growth is increasing, consumers like you and I can borrow more and spend more, and businesses can borrow money and invest in new projects. Do remember that companies borrow money in crores, not in the lakhs that we do. So, credit to a nation's development is the engine of its success. In the news this week, bank credit grew at 16.2% in the fortnight ended September 9th, the highest in about 9 years. This was on the back of a revival in economic activity, rising working capital demand, and rising discretionary spending, and to some extent a favorable base effect. If you look at the chart on your screen, credit growth has been extremely strong over the previous few months. And this growth has sustained a rise since April this year, despite the RBI adopting a tighter monetary policy stance. Now, this indicates that even when interest rates rise, firms and individuals continue to borrow money. The availability of credit, even at high interest rates, is a good thing since borrowers may pass some of the increased cost on to consumers because they're aware of how the macroeconomy is changing. However, the lack of credit availability will deprive businesses the opportunity to grow. Now, when we look at the sector breakup of credit growth, it looks broad-based. So banks usually lend money to the Food Corporation of India and other state procurement agencies to primarily buy rice and wheat directly from farmers at the government-mandated minimum support price. Now, this is referred to as food credit. Once these loans are subtracted from the overall bank loans, what is left is called non-food credit. So to get a clear picture of bank lending, let's look at non-food credit. There are four basic categories for non-food credit: agriculture-related activities, industry, services, and personal loans. In the past several years, the credit offtake to personal loans category has emerged as the key growth engine for non-food credit. Now, personal loan category saw strong growth and has been driven by sustained retail spending. This shows a pickup in the economic activities in the country. Now, similarly, the corporate sector is also showing encouraging signals of growth. Working capital needs are a major factor contributing to the rise because private capex is still expected to see a pickup. Agricultural credit growth also remained broadly resilient. Services sector, which was the most impacted due to COVID, is also firmly back on track and saw a strong credit growth of 16.5%. While credit growth has seen sustained growth, deposit growth remains modest, and this escalates worries that a weak deposit growth may turn out to be one of the major barriers to credit growth. As per the latest data, deposits have registered a growth rate of 9.5% year over year as of September 9, 2022. But deposit growth is expected to see some uptick in the current rising interest rate regime. Now, what are the key takeaways on credit growth? Given the approaching festival season, the credit growth in the country is likely to remain elevated. The outlook for bank credit growth is positive due to the ongoing economic expansion, rise in government capex, and a gradual rise in private capex too. Capital utilizations are also rising, and the extension of emergency credit line guarantee scheme for MSMEs are also other reasons. Now, while we expect credit growth to rise, some downside risk to credit growth cycle could emerge from the widening gap between deposit and credit growth, which could lead to supply side constraints. In the near term, mobilization in deposit growth will remain key going forward. The banks are set to increase the deposit rates further to garner more liquidity in the system. The main goal of a central bank is to maintain price stability. As a result, they must manage both inflation, when prices rise, and deflation when prices falls. Now, inflation is skyrocketing in most emerging and developed economies. Excessive inflation can be damaging to any economy, which can depreciate the value of private savings and erode the profits of businesses. In an inflationary environment, bills rise in price for everyone from individuals, corporations to the government. Naturally, the central banks use interest rates as monetary policy tool to limit inflation. A higher interest rates enables the central banks to slow down the money supply and investment activities in the economy, which is instrumental in controlling inflation. Now take a look at this chart on how central banks across the world are raising interest rates to curb inflation. Now, from Friday's monetary policy review, the RBI has done two things. One, it has raised the repo rate, that is the rate at which it lends money to the banking system, by about 50 basis points. Two, it has cut India's GDP growth forecast for fiscal year 23 from 7.2% to 7%. Overall, the policy rate hike was largely on expected lines. Taming inflation and ensuring macroeconomic stability has remained key priorities for the RBI. So why has RBI cut India's growth rate? India grew by 13.5%, but RBI had expected to grow by 16.2%. It was expected that India's overall growth forecast of 7.2% might take a hit. Another reason for cutting the growth forecast was the fact that since April, when RBI first came out with the growth forecast of 7.2% for the fiscal year 23, interest rates have gone up by a massive 190 basis points. Now, this had to take its toll on the growth rate, regardless of the slower than expected Q1 data. Now, despite the rate cuts, India still remains one of the fastest growing economies in the world. Now, let's talk a little on India's growth outlook. Overall, the global slowdown and uncertainty are triggered more due to output contraction in the advanced economies. Now, global events will of course naturally impact India through weaker export demand. But Indian economy continues to be predominantly domestic driven, with consumption and investments contributing to about 70% of the economic activity. Now, regarding the domestic recovery, it is still strong, with strong growth impulses becoming more widespread as demonstrated in high frequency numbers. Now, industry and services activity also remains robust as indicated by the recent PMI numbers. Capacity utilization has also improved and credit growth is also at high levels. Government finances are also in order with tax collections remaining robust. Now, desire of global businesses to look for more resilient and cost-effective investment and export destinations, among other factors, will also help India ride this tide of headwinds. We've also managed inflation better. Therefore, when compared to some of its other emerging market peers, India does check a lot of boxes. Now, while domestic fundamentals of the country remain strong, most risks are currently emanating from external factors. Even though it has suffered some little damage, the Indian economy is still resilient in the face of many challenges. So the question of India's economy remaining resilient is true. While I say this is me, Merlin Susanna, signing off. Take care and stay invested.
Did you like watching this video? Then download our app, Informed Investor, to watch more such informative and interesting videos.